Welcome, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the podcast, my guests and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. If you're new to the show, you definitely are going to get a lot more than just your basic real estate housing information. Housing's up or down, and interest rates are up or down. We go into what's behind all of this, what the Federal Reserve is doing and saying each and every week. I mean, obviously, we have an artificially manipulated market. In the real estate market, the stock market, everything is being manipulated masterfully, I might point out, to this point. But at some point, things can change. We're always giving you the up-to-date information so that you can make the most informed, educated decisions in regards to your real estate and many other things as well. Like I said, we're going to talk credit. We typically give a credit tip each week. This week, we're going to talk about secured credit cards and why you should pay attention to them. And actually could be costing you, 50 to 100 points in your credit report by not paying attention to those secured credit cards. We'll jump into that later. We've got to talk about Janet Yellen and her testimony to Congress this week. We also are going to talk about some of the other geopolitical events that have been taking place in Israel and Russia that are important and that have effect overall on the real estate market. Obviously, when there's geopolitical events taking place, interest rates tend to get better, meaning that money is jumping back into the safe haven of bonds, which pushes interest rates back down. We actually have the 30-year bond at a one-year low this week, which one would think that the housing market would be absolutely booming right now with interest rates dropping down to the levels that they're at, but that's just really not the case. We'll jump into that today. Joining me on our panel, as he does each and every week, is Louis Camarosano, who's a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's also been cited in the media as a real estate industry expert. He's been cited in Inman News, Wall Street Journal, Forbes, Fox Business, U.S. News, MSN, and numerous others. Louis, how you doing today, buddy?
Ryan, I'm doing grand. How are you?
I'm doing well. Thanks for asking. So, we've had a lot actually transpire since the last time we spoke. And I kind of want to start, let's see, I'm going to start before we jump into the Fed and all that Janet Yellen said this week. Let's kind of jump into some of the economic data that took place this week, which one of the more interesting numbers, obviously we have the initial jobless claims, which came in a little better than expectations, 302,000 versus 310. We talk week after week that these numbers really don't mean anything. Great that part-time jobs are being created. We really don't have any wage growth at all. And, full-time workers are actually falling from the workforce. So replacing full-time workers with part-time workers is not a model for success. I want to kind of get your take on that, and also housing starts. So housing starts tanked. 893,000 versus the estimated of 1.018 million, plus the prior period was revised downward from 1.001 million to 985,000. Now, that information didn't really get pushed out there in the media. What did get pushed out there was that looks like, building permits are up. So it looks like it missed, the number missed, but they're still saying, well, look, it looks like we're moving in the right direction building permits. So it appears that the builder are actually pulling permits, but they're not actually building. Which is an interesting thing to have happen, because that essentially tells me that the builders have kind of lost a little bit of confidence and they're pulling the permits, but they're not going to plan on building until they sell, one house at a time and move as their money comes in. Want to get your take on the housing starts, building permits, and the jobless claims. Where do you think we're moving from here? Obviously, we're heading into, the third quarter. And what's your take on the future outlook of the rest of this year is?
Ryan, I've basically written off housing this year. I had written it off last year based on the leading indicators for the housing market. And housing has gotten too expensive. The volume of sales are down. The job market has not improved to the point where we have enough people with good jobs and increasing their wages so they can buy houses. And we've seen it. The interest rates have gone down. You can't blame low interest rates for the lack of sales. You can't blame the weather for lack of sales. We've now seen that these sales have not picked up, and we're almost halfway through with the summer. So housing is basically, in my mind, a a dead fish. And Janet Yellen mentioned in her testimony, I think she said the housing sector has shown little recent progress. And then she said this sector has recovered notably from its earlier trough, but it's leveled off in the last year. Well, yeah, it really hadn't picked up much other than the sales had increased. And I saw Reuters had printed a chart that I had published back in February, which basically showed over the long term, the 20, 30-year chart of new housing construction and new home sales, they're at basically 30-year lows. Yeah, they've gone up a bit over the last couple of years, but they've gone up from this, from this tremendously low level. So I really think that housing is not going to improve. The Fed has kind of written it off, and where all the attention now is for the economic cheerleaders is in the jobs report. They're claiming, as you mentioned just now, that these part-time jobs that are being created, they're touting them as some kind of evidence of a mega recovery and that the economy is accelerating. It's not. The initial jobless claim we talk about week in and week out, so it's down to 302,000. And again, that's just a function of fewer people left to fire because the labor participation rate is lower, the labor force is smaller, so there's fewer people left to fire. There's not much in this economy now that they can hang their hats on, but that does not stop them from making every little piece of information that might be viewed as positive into some type of mega economic news. Now, we forgot to mention the PPI, not the PPI, yes, the Producer Price Index was up 0.4%. The Fed has been complaining for years now, we don't have enough inflation. They have this misguided notion, Ryan, that more inflation somehow means more jobs, more productivity. It doesn't. It just means prices are higher and people are struggling with part-time jobs. The price of food goes up and the price of gas goes up. That doesn't mean there's more production in the economy. Just things are more expensive. In fact, higher gas prices mean people don't go anywhere. Less economic activity takes place. Prices rise, you buy fewer things. We are a consumer-based, consumer-spending economy. And if prices rise, our economy goes into the tank. It's not a sign that somehow things are getting better. It's a sign that all this money printing has finally caught up with them. So I don't see, Ryan, where we have a recovery. We talk about this every week. The jobs are not there. The inflation is picking up on the price side. We don't have a housing recovery anymore. We had it in price. That was a dual-edged sword. That basically has scared people away. It's too expensive to buy a home. You're not going to buy one. So my take right now is you had mentioned, Ryan, that all they would need to claim this year as a success is one piece of positive economic data, then they can say everything is fine. I think that's what they did with their non-farm payroll that they released around the 4th of July that showed those 288,000 jobs. But they didn't mention the 500,000 full-time jobs lost, that the reason they gained a net 288 was that they had an increase in part-time jobs. They'll probably get another non-farm payroll number early next month, similar, and they'll jump up and down and say, see, this is why we can taper. This is why QE's been a success, and it hasn't.
Yeah, I mean, it's amazing. I mean, there's so many quotes I can pull from Janet Yellen's testimony that it's just mind-boggling. How it's like she's playing both sides of the fence at all times because they have to remain in control, and the best way to remain in control is to not answer questions that you don't want to. And basically, when you see things moving too far in one direction, you just start pulling back a little bit because you don't want them to get out of whack but so far. And that's kind of where she started going. Now, before we jump into Yellen and her testimony, I did want to mention that, all these economists have been predicting for some time that obviously, we're moving in the right direction. Interest rates were going to start rising. I mean, we're going to get close to the 5% level by the end of this year. Lewis, we are nowhere close to that. We're nowhere close. Now, the reason why the economists can't be right is because they're trying to base their things off of this sort of economic theories and fundamentals, which the market has none of right now, right? There's nothing behind what's taking place, so you can't really predict the future. That's why you and I have been wrong numerous times in the last couple of years, is because we're basing our future forecasts off of what we would think are fundamentals for companies and fundamentals for the economy, but that's all gone out the window. We have the 30-year bond at the lowest level in 1 year right now. What does that do to? Mainly geopolitical events. And what has been the dominating force over, I would say the last 2 years is every time something, we get too much press talking about, the United States economy and where it's headed, and we have something pop up overseas that then turns into above-the-fold news, front-page news, where everybody is now, look, it can't be so bad here. Look what's taking place over there in Russia. Look, the Malaysian plane went down. Or now we have Israel that's getting ready to invade Gaza. I mean, we've got...
When Microsoft fired 18,000 people.
Right, because that's not important, really, because in theory, we don't really have planes crashing in our country right this second. So we'll just worry about what's taking place there. So yesterday, when the plane went down, obviously the stock market got worse. And where does all the money flow? It flows right back into bonds and mortgage-backed securities, the safe haven of that. So we're benefiting from all this geopolitical stuff that's taking place. This has been going on for some time. It's not going to stop. I think the Fed knows that the way the media, they're driving this economy in the direction that the Fed wants, because the Fed can put out whatever information they want, and the media can really push their agenda. So this is going to continue. And Janet Yellen, she basically came out in her testimony and said that the economy is going to grow at a moderate pace over the next several years.
Yeah, she knows.
She already knows. And you know what? She's kind of dead in the water, because she came out a couple times basically starting to really mention that, why the Fed is so puzzled that there's the lack of volatility in the financial markets. Really? How are you puzzled? Because your whole agenda was to prop up the stock market. But
they know that's what you're going to do. And if you got anything out of her testimony, was that she's there and the Fed is there to prop up the markets. So why would there be volatility?
Absolutely. And what was interesting, though, was she made direct comments that she felt like there was a bubble in social media technology, right, or stocks, right, and biotechnology stocks. They're basically getting out of hand. What she's really alluding to is that there's no basis for or no fundamentals behind the valuations of these companies.
That was her Greenspan, questioning whether we have proper valuations or rational exuberance, Ryan. She was trying to say, yeah, there might be a bubble. But the Fed has consistently stated for the last 20, 30 years that, even Greenspan said it, it's not their job to prick bubbles. It's only their job to blow them up. And no one sees the irony in that Yellen has stated repeatedly that, during the housing crisis, before the housing crisis, well, I don't see a bubble, but if there is one, there's not much we can do about it. No, they can't raise rates. They can't do anything about it. There's nothing the Fed can do right now. They're in one direction, which is keep interest rates low and print money to keep them low. And that's it. Now, if you look at the Russell Index, Ryan, on the Russell website, they show that the average PE is on this company, I think it's about 25, 26. Not bad. I mean, it's a little high. But what they fail to mention is that they don't include companies that don't have earnings, which are a good number of them. If you put in the companies that don't have earnings and you do the calculation, it's 76 times earnings. So how could that possibly not be a bubble?
Right.
That basically you have companies with valuations at 76 times. No company grows, maybe a company might grow that fast to grow into that valuation, but most don't. Right. So they're clearly overvalued. They like this kind of stuff. They think it trickles down. People get rich. Their portfolios are up. The problem with all this, Ryan, is, it's going to happen if you have stock market valuations with no foundations, as you pointed out, no economic basis in reality. For them to be this high, they can go down at a moment's notice and stay down. People keep thinking that when the stock market collapses, they're going to climb back in. Well, that assumes that those companies are seaworthy. And then when when the stock market collapses, it's not going to take the economy with it. If people aren't spending money now, do you think the prospects of companies are going to be better after a stock market crash when most of the money that's being spent is either borrowed money or money made in the stock market or pulled out of home equity? Those companies aren't going to rebound in a way that are going to make them attractive based on the economy. And the only thing that can happen is the Fed has to double and triple down and pour more money into it. I think at that point, Ryan, this is what I want to get your take on, is if the Fed jumps in after a correction of 10, 15, 20, 30%, which I think is going to happen, at that point, I think they either totally just dominate the market, just take over the market. I mean, they already have so much money in the market. They just kill the free market, or they kill the dollar just to support the stock market.
Yeah, well, I mean, one of her comments was that if economic performance is disappointing, that the future path could be more accommodative than currently anticipated, right? So she's basically telling us that if things get worse. Now, I think she's starting to acknowledge just a little bit by saying, hey, we see little to no wage growth, and we don't really understand, things aren't as good as what we thought. And then you got Bullard, St. Louis Fed president, on the other side talking that it looks like, we might have to end this program sooner than anticipated. We're probably going to have to start raising interest rates. So they can play both sides of the fence, as I mentioned, and, accomplish what they want, which is to keep people completely confused about the situation, right? Nobody really understands what's going on other than a couple of people, you and I and everybody else, that believes that what the Fed's doing is so destructive. But I am really, really kind of now, the way she's kind of shifted her comments, I think that she wants a little pullback in the stock market now, Louis.
Sure, absolutely.
You know what I mean? Because I think that they need that. They need a little pullback because she says she's starting to realize in their comments, basically, where, they're completely confused why there's not volatility. Well, what better way to create the volatility than to open your mouth up about certain sectors, right?
Right.
Because if you do that, then all of a sudden what happened yesterday? There was a dip in the technology sector. Because anything that the Fed says and does, everybody's going to basically react on Wall Street in lockstep with what the Fed says.
Correct.
So if
they say don't fight the Fed, and there's a reason for that.
Yeah, exactly. So what they said smaller tech companies appeared stretched, and guess what else they said? The valuation of assets, including junk bonds, were also stretched. Okay, so basically now we've got two markets that I bet you if we pay attention over the next 6 months, Louis, they're going to start tanking. And
unless she comes out and says something positive or retraces her steps.
Exactly. So they're basically, because this is such an artificial market, well, everybody's like, well, hey, if Yellen says this, I guess we better reconsider. They
manipulate in so many different ways. They manipulate verbally. They manipulate by participation. There's no end to how they manipulate and try to get the desired outcome. That's what I'm saying is if there is a stock market crash, it's all then down to the Fed. The market won't be allowed to readjust and restructure according to valuations that make sense. They won't allow the stock market to go down.
Yeah.
They'll have to try to boost it back up.
Right.
But the problem is they've already printed $4 trillion, and they're going to have to put more liquidity into it. And at some point, people have to lose confidence. You would think they would lose confidence in the markets. But, if you get a positive outcome, then you gain confidence in the markets that they never go down. That's kind of what they had to do with the house. They had to pump that back up. So you said, no, that was a once in a lifetime crisis. Prices went down, but you see now they've gone back up.
Yep.
They want to do the same with the housing market. What do you think of Russia? Before the plane went down, Ryan, I wanted to get your take on the sanctions that Obama placed on Russia, and then the Russian response, and then your reaction to the plane downing, how that factors into where Russian, U.S., European relationships go in relation to the dollar and the economy.
Well, I think it is completely it's interesting the way the timing of everything, isn't it? I mean, of how that plane went down and the sanctions that were placed by, it was the EU and the United States.
Right. So, they're not. The EU is less willing to go along with the full sanctions, but yes.
Yeah, I'm curious to see how this is playing out. I mean, I honestly feel like it means nothing. We can place whatever sanctions we want on Russia, but at the end of the day, they're going to do whatever they want to do. I don't really think that it's affecting them. What do you think about that?
Well, I think it's going to affect us because one of the themes that we talked about over the last couple of weeks is the United States is definitely trying to protect the dollar and its image of a sound currency, and that's why I think they're stopping QE, is to say, look, we did it, it was an emergency, it worked, and now we're cutting back, and one day we'll raise interest rates so the dollar is sound. But what they've also done is they've tried to kind of in an aggressive way, protect the value of the dollar by fining a French bank, but because what I believe is that they were dealing with Iran, and Iran doesn't deal in the dollar, and they can't have the French, breaking ranks. So they put a $9 billion fine on them. Well, if you have to, in order to deal with the dollar, you've got to pay $9 billion. You start thinking, I can deal with Russia. I can deal with China. It's not going to cost me $9 billion. I can deal with Iran. And, what do I get out of the United States? And then you have FATCA came into play. All the banks now are subject to, again, fined if they don't act as IRS snitches on U.S. Customers. So, again, you're placing a burden on people using the dollar. And then you have, I don't know if you saw the BRICS announcement, they're setting up kind of their own, like IMF bank where they're going to fund it $100 billion. China is like 41%, and the other countries are about 16%. And the idea there is that they are going to trade amongst themselves and not use the dollar. So all these sanctions, they're kind of short-sighted because Russia, after the Cold War, was basically a neutral country. They had resources. The United States didn't really deal much with them, but, they played along and they bought U.S. treasuries and they used the dollar. Well, the United States has kind of pushed them away. And they're also pushing away some of our other partners like Saudi Arabia, who basically is the underpinning for the value of the dollar because they price their oil in dollars. They accept only dollars. But Saudi Arabia is annoyed that we didn't attack Syria. And so when you get these kind of rumblings where countries are not receiving the benefits of using the dollar, they could be penalized for using the dollar. You have outright sanctions. You have fines. And then the value of their dollars over the last 5 years were diminished because the Fed did something which is an abuse of the world's reserve currency, which just printed up $4 trillion because we needed the money. we needed to prop up our banking system. So, hey, as John Connolly said when Nixon took the United States off the gold standard in 1971, he told the G7 nations, it's our currency, but your problem. Well, it's the same now. It's even more in your face, but back then the United States had more playing cards.
Right.
The United States in 1971, Ryan, was the dominant superpower in the world economically, politically, and people had to take the dollar. Well, now there was no movement for countries to put together alternative arrangements not to use the dollar, and that's the biggest danger. And it doesn't happen overnight. Everybody's talking about the dollar's going to collapse, and there's going to be this one event. No, it happens slowly.
Yeah, it's over years and years and years is going to happen. But yeah, I agree with you. And it was funny because when the plane went down, of course, the Ukraine officials are saying it's a terrorist attack. Russia says that they know absolutely nothing, right? Russia never knows anything, stuff like that. And the separatists are blaming the Ukraine for this. So, and when that happened, obviously the stock market took a hit. Interest rates fell. But as you mentioned before we came on this call, the State Department really made no reference as yesterday when they had their meeting. And you can kind of dive further into because you read that article, but I didn't even know anything about that, which I thought was interesting. They didn't even make a comment on it.
Yeah, well, the idea there is another theme that we've talked about, Ryan, is that not so much the Fed, but the media. The Fed has been relatively straightforward on their assessment of the economy other than their projections. They'll basically give you the straight dope that things aren't that good, but they keep telling you, wait till next year. It's getting better. It's getting better. The media either ignores bad news or, as we discussed, makes a mountain out of a molehill of positive economic news. So a plane went down. The State Department has its meeting. They're not going to say anything about it. Why do you, it's just a plane. It's just over the Ukraine. It's just where we've been putting sanctions on Russia. It's one of the hot spots in the world. I'm sure I don't even know if they mentioned the ground invasion of Israel into Gaza in that State Department meeting. Who knows? But these are things that are significant. They impact the economies. They impact the stability of the world. And just like when the Portuguese bank went into default, the Bulgarian bank, there's immediately these stories about why it's not a big deal. It's contained, the famous subprime. It's contained the subprime is what they said prior to the housing crisis. The Portuguese bank default, and we talked about this, right? It will have cascading effect. There was one that came out, and they did report on it. There was a telecom merger where I think the details were that there was a Portugal Telecom was going to merge and did merge with the Brazilian group, but because the bank owed the Portuguese telecom company $1 billion, well, that was $1 billion that they couldn't put up to get the type of stake they wanted in the joint venture. All right, it doesn't just end there. You can imagine, well, if they don't put their $1 billion in and their stake is reduced, what about all the other people who had money in deals and things riding on and the assumption that Portuguese bank was going to pay them? Well, they're not. Well, then it has cascading effects. And you know how all the world is intertwined with credit defaults, swaps, and hedging and so on. One default leads to other defaults.
Right.
And you don't know where it ends. And it's not just Portugal. The Bulgarian bank, there's a little fraud there, so don't worry about that either. And that's where we are, is this kind of no one wants to... Here's the thing, Ryan. No one, if you're a doctor and a patient comes in and they've had a serious injury, you don't want the doctor to say, oh, my goodness, look at your arm. You're going to get gangrene. This is a disaster. You don't want that, obviously.
No. Right.
But you also don't want the doctor to say, hey, nice shirt. Hey, we'll get you stitched up and out of here in 2 minutes. You want a realistic assessment of what's going on. And we're not getting that from the media. They're just basically saying, either, don't worry about it, don't even report on it. There's nothing to see here. And the other thing they do, Ryan, which is, yesterday gold went up. And, of course, the last thing that, people want in power and for the dollar and so on is for when there's a geopolitical crisis for people to go to the dollar. That's just, to go to gold. That's basically a sign that, hey, when the chips are down, that's what we want, gold. And that is that's anathema to them because they do not want gold to be seen as the real currency, gold and silver. Right. So yesterday there was, and I've been keeping track of this. When the stock market was down a point or two, there's not a slew of stories talking about stock market's overvalued, the stock market's going to crash, stocks are a bad deal. But over the last 2 weeks, I've seen at least a dozen stories, the purpose of which is to mention why gold isn't a good investment. Mainstream media stuff, Market Watch, CNN. Right. And then even if the story is not directly about gold, they're always quoting it. They had one guy saying why it's going to $700. Why is that important? They just have to get that out there constantly. But anyway, yesterday before the plane went down, they had another one of these articles in Reuters, and they have a quote saying, physical demand is low. Everything is fine. Interest rates in the U.S. are expected to rise, and if interest rates rise, then therefore there's no need to hold gold because you can get a return on your money. Interest rates aren't rising. And then they said inflation is nowhere to be seen, is not in sight. Well, that's not true. Yeah. Inflation by their CPI and PPI numbers is already well past the Fed's 2% inflation target without any of the benefits, supposed benefits that you get from having it. And then it said Southern European banking jitters are calming down. Why? Because you say so? They're not calming down. We just had this cascade effect with the Portuguese telecom. That's not a mental state. These things take time to work through the system. And then it said, and geopolitical tensions are not looking as if they would spread. Right. Again, that's just wishful thinking. Then when the plane hit, Reuters removed that paragraph because obviously you look foolish saying that geopolitical tensions are not looking like they would spread when Israel announces a ground invasion of Gaza and a plane goes down over the Ukraine. But you see what they did then next, Ryan. The story still had to be about gold going down. So they replaced that sentence with saying all these things are moving quickly and the price of gold could still go down.
Yeah, it's like it doesn't matter what happens, right? They just always have to make it seem like we have such a sound economy that gold is such a bad investment. You know what I mean? Right. Stock market's going to continue to thrive regardless of what takes place. And I think you're right. You know what? We always get these geopolitical events. They'll hit the front page news for a day, right? Because it'll just basically show the world, hey, look, everywhere else is so much worse off than we are, right? These things are taking place in every country around the world. Look at what's happening. So the stock market takes an initial dip down, but they don't keep reporting on the story and the potential implications and consequences from what's taking place over there, right?
Like I said, they don't need to do it incessantly like the world is ending, but they just should point out the risk. They ignore the risk, downplay the risk, and then upplay why everything is wonderful.
Well, and you know what?
And they're not fooling anyone. Because you read the comments under all these stories, hundreds and hundreds of comments, basically laughing at the way the article is written.
Right. Well, it's funny you're talking about risks and consequences because part of Yellen's testimony, I can't remember who it was. It was one of the senator, Democrat from Montana or something like that, asked what the greatest risks to the growth forecast that the Fed had, right? Well, essentially, she didn't want to answer that question. She doesn't want to talk about the risks that could affect that growth forecast because guess what would happen if she answered that question, Louis?
Well, then people would think about it, report on it, and it might stick in people's heads that maybe there's a problem.
Right, so if she starts talking, there's some serious geopolitical things going on that could really affect our growth forecast, what would happen to the stock market, right? Like, she won't answer those questions. And then further on in her testimony, I could not believe this. So Senator Elizabeth Warren asked Ms. Yellen whether J.P. Morgan Chase had complied with a legal requirement to provide the Fed with a credible plan for its orderly dissolution should that become necessary, right? So they were supposed to have created some sort of plan here. And Warren went on to ask her, and I'm quoting here, can you honestly say that J.P. Morgan could be resolved in rapid and orderly fashion with no threats to the economy and no need for taxpayer bailout? Now, do you think that Ms. Yellen answered that question, Louis?
Of course not.
Of course not. You know what happened, though? She basically didn't answer the question, and then the hearing ended abruptly. Elizabeth Warren walks over to Ms. Yellen, kisses her on the cheek, and the two women start laughing and chatting. So what do
Elizabeth Warren is she's almost like a plant. She gets out there with that fake outrage, complaining about what has to be done, but she's part of the system. She's not looking to upset the apple cart. She's not asking the questions like Ron Paul and antagonizing Bernanke, when he would hold up a silver coin and say, what's this? Is this money? Asking him if gold is money. Asking him if one question that Ron Paul once asked Bernanke is like, after you do this for 6 years and it doesn't work, will you ever admit that you're wrong? That's not what she's saying. She's asking a question, she doesn't get an answer, and then you go over and you kiss her on the cheek and they go to a cocktail party for women political leaders.
Absolutely. And, it's funny because guess what Warren can say? She can say, hey, look, I'm asking a tough question. But
she's got a clip for when she runs for president, how she's gonna be on the side of the people and she's going to protect the people against the banks. Yeah, just like Obama was going to shut Guantanamo and he was going to make sure that everything was transparent. No, they're not. That's just what they say to get elected.
Right. But you know what? It's how we always talked if we were allowed to sit in these meetings and the questions that we would ask, right? So if we wrote our congressperson and said, hey, I really want to get answers to these questions, and they asked the question to the Fed, the end result is if she doesn't like the question, she will not answer it. What she will come back and say is that I am confident that we will, we will be moving in the right direction for the coming years. Right?
And I want to know who's buying the bonds out of Belgium. Simple question.
It's a simple question, right? And what would her answer be? She wouldn't answer that.
Well, the one thing the Fed does, and Bernanke has done this, is and they make the point that they're independent. If they are buying them, they don't have to tell you.
Yep.
So they're transparent because by their own because they want to be good guys, they're going to say, I'm transparent. But they're also going to tell you, if we don't want to be, we don't have to be. So then it's a farce. If you're not required to tell the truth, but you voluntarily tell the truth when you feel like it, that's the same as lying.
Right.
And that's the one thing Bernanke once said was someone was questioning him on what the Fed does and how they do it. And he basically said, well, that's how it was set up by Congress. If you don't like that, change it. But in the meantime, we can do whatever we want. And Greenspan said this, no one can do anything to us. There's no governmental entity that can second guess or change our decisions. And they don't even have to tell you what they are.
And they can't even force them to answer basic questions.
No. So she can go there, and this whole nonsense now that they have, where they have these Bernanke started this, transparency, having these press conferences.
Right.
They're just they'll tell you what they want to tell you, but they don't have to tell you anything that they don't want to tell you.
But do you know why?
So basically, it's not even for our benefit. It's worse because now they have a platform for their propaganda.
Correct. That's what I was about to say. Now they can push their agenda. You know what I mean?
Whereas before they had to do it kind of through statements.
I actually thought that was probably the better way to go, because now it's like they just feed us the load of crap that they're going to give us at every meeting, right? And
the reporters eat it up like they've been being told the whole truth, nothing but the truth.
Exactly. And they're like, I wonder why does she think all of a sudden that, wage growth has just really started to not go anywhere and stagnate? You know what I mean? And why is she worried about that all of a sudden? She hasn't worried about it for the last meeting because you know what? She needs another talking point. She needs to shift the attention from one issue to another. Why have as you mentioned, has housing disappeared from these conversations? Because she doesn't want that to be the focus because it's so negative. So she can.
Housing was the linchpin of the recovery. They were going to boost housing prices back up. They were going to regain that equity. It was good for the economy. You cannot have they said this. You cannot have a recovery in the United States economy without a housing recovery. I've always thought that was a stupid way of running the economy, getting more people move in and out of used houses. But still, that's what they believe, and they're not getting that.
Right.
So they don't talk about it.
Well, Yellen made reference that, obviously we know where the PPI is and everything else. She made comments that firms are not facing much in the way of cost pressures. Says who? Says who? How are these?
She doesn't want them to have them.
Yeah, I was about to say because.
Well, she said inflation is noisy. And noisy. Well, what does that mean, noisy? It's a statistic you don't like, so it's noise.
No, noisy means to me that they know that it's going up, and they can't say that. You know what I mean? Not until they've printed or done whatever they want. They are not going. They set these goals and they just keep changing them. Remember when unemployment got down to 6.5%? That'd be the time to stop QE and raise rates. Well, it's below that. According to the official numbers, it's way below that. Same with the inflation rate. Now those are target. They're not really set. Why even bother even giving them? Right.
Now they're saying, we can, for a substantial period of time after we hit the target, continue to remain highly accommodative policy. Yeah, well, what does that mean? She says highly accommodative policy every meeting.
Right. Yep.
And there's always a change of when she's not going to be highly accommodative.
Well, what's interesting is, and for many of you listening, I mean, obviously a lot of what we're talking about is this kind of high-level stuff as far as how this stuff impacts bond purchases and things like that. But it's on the most basic level. So we have mortgage-backed securities and we have bonds out there that people are buying up when there's, instability in the overall global world. That's what happened. So when the plane crashed yesterday, money came out of equities and poured into the safe haven of bonds. Well, the arch enemy of bonds is inflation, right? And the last thing that the Fed wants is for money to be pouring out of bonds. Somebody's got to buy our bonds, right? And if inflation sets in, which it already has, but not from their readings, then interest rates would skyrocket, essentially. That's what would happen. So that's why it's so important for them to continue to talk that it's moving toward their target. You know what? We may never hit the target. We could be at 20% inflation, and they wouldn't recognize it as
no. They would use
the
hedonics and the CPI. They talk about how the PPI is temporary. It's volatile. It always goes up, but it's still volatile. Strip out gas, strip out energy, strip out housing, strip out everything, except the one thing that didn't go down, salt. It didn't go up.
Right.
Salt. See, salt has been the same price for 40 years, so we don't have inflation. Well, so everybody go out and buy salt. It's still a bargain.
Well, you know what I found hilarious? I was watching the Squawk Box the other morning, and I get a kick out of it because more or less it gives me more talking points for our show, Louis, because these guys and the stuff they say is incredible. But I can't even remember who was on there. He was the head of a big bond firm, and I don't know if it was PIMCO or one of them. And they one of the hosts, Joe Kearns, I believe, had asked him about inflation. Was he worried about it? Because obviously when you're a bond trader, it's a big deal, right?
Right.
Well, what did he say? He said, well, I'm not even really worried if next year we go to 3%, because in order to get that average of that 2%, you have to have a year where 1 year it's 1% and then another year is 3%. It doesn't really bother me.
If it averages out, that's a Yellen type or a Bernanke type response.
And I was about
so now
to
they
say,
haven't passed their target; they're averaging towards it.
And you know what? As long as they stick to that mantra of hey, well, essentially, it's okay. This is going to average out. It's a good thing. It's going to see. We've seen from previous dealings that it's gone up and then it comes down below the line. This is Fed talk, and this is what bond traders, this is what stock traders, this is what they have to peddle. They have to.
Ryan, because if the Fed has their back, they're not going to start criticizing the Fed. They're making money hand over fist. They don't care that it's artificially induced. The last 3 years, if you've been in the stock market, you made money. That's not fake money. That's money you go out and buy real goods and services with.
Yeah.
So, that's looking a gift horse in the mouth. They're going to start complaining.
Right. You don't complain because, you're
being taken care of.
Yeah, you're biting the hand that's feeding you, right? I mean,
yeah. What do you get out of that other than intellectual honesty and conscience?
Right. And so that's why
you're being bought off, basically.
And more to the point, Lewis, of when everybody's like asking me when can something happen. Well, the rise of a lot of these geopolitical events definitely, I think, could speed up the process of some sort of bad event taking place here in the United States. But outside of those geopolitical forces, the Fed is going to continue, as I mentioned, to stick the course of it's going to be immoderate for.
But Ryan, don't you think at some point, and this happens all the time, you get to a point where everybody knows that this is a farce. There's no way that people are in stocks actually believe that the companies they're bidding up, that they've been holding, that have gone up 30, 40, 80% in the last few years, are worth that. They know that. But they're not willing to be the first one to say it's not there. If you remember what happened in the .com era, it basically took an article, I don't know, it was in Barron's, it was one of the big papers, one of the big weeklies, and it said, .bomb. And everyone's like, yeah, these companies don't make any money. Not only do they make any money, they're eventually going to run out of money. And what's the point of holding them? And it just cascaded. It's the same now, Ryan. People are going to look at them and say, at some point, traders, even people that have bought a hook, line, and sinker, they're going to take their money off the table. Other people who are attracted to it are going to say, well, why do I own this stuff? And they're going to sell. And I think that's going to happen very soon. We're going to see a massive correction, and then they're going to see a mistake where people think we can just dive back in because the stock market's going to go back up. But if the whole recovery is based on rising stock prices and rising home prices, but not underlying production, not underlying sales growing, then why would the companies rebound? I keep getting back to that. I think this collapse will be different than the other stock market collapses. Because in 1987, when the stock market went down, the economy was fundamentally sound.
Right.
And it went back up also because Greenspan made a statement they were going to pump liquidity into it. And the same with, after the internet bubble, the economy wasn't that bad. People were working, and there were massive layoffs on the internet section.
Right.
But now we haven't gotten past 2008. The economy hasn't improved, but the stock market, if you think about it, it's at all-time highs, which would indicate that the U.S. economy is at its all-time peak. It's nowhere near. We're probably 40, 60% off our productive capacity in the in industrial production. I mean, there are no factories here. So what do we produce? No. So Twitter is up, Zillow is up. So seriously, they're multi-billion-dollar companies, and they don't make any money. And then you say, okay, well, what about the big companies? Yeah, what about the big companies? Your big retailers, they're not making as much money as they used to. Their sales are down. Restaurant sales are down, and it's not the weather.
Right. But,
has anyone realized that yet? The second, and the economy is going to accelerate in the second quarter. Well, the economy is going to accelerate in the third quarter. It's going to accelerate, in 2019 in the fifth quarter.
Oh, well, did you see, it was somewhere where they were, it could have been the Fed that was talking about, what was going on, maybe it wasn't the Fed, I don't remember who it was, but they were blaming a lot of the housing starts and building stuff on the southeast region. They were the ones putting a drag on the overall economy. Like, they always can blame some portion of the United States. They can blame the weather in a certain area of the United States. They can use whatever they want. As you mentioned, we had a late winter. We had the polar vortex coming through, snow in the Midwest, right? So we've got all these things that we can point to that would say that, hey, this can slow. And that's why, honestly, it's a joke, Louis. I mean,
total joke.
You and I could just create whatever we want. We could just say, you know what? It looks like more people went on vacation this week, so production is definitely going to be down. You know what I mean? That shouldn't change. Like, people don't stop buying stuff. We bring this up all the time. If people have the ability and the means to buy stuff, whether it's houses, cars, whatever, and they have a stable job, they have growing wages, that would be the real consumer confidence that would be there to allow them to do that. But the reality Remember the Gallup survey last week? It showed where they're spending money. More on what they have to and less on what they want to. Yeah, but remember, firms are not facing much in the way of cost pressures, Louis. They're not.
That's why they can't buy what they want. Right?
Exactly. I mean,
they have to spend more on stuff that's going up that they need, like gas, electricity, housing, and less. Maybe the stuff that they want isn't going up as much, like consumer goods. Doesn't do them any good. And the reason they're not going up is the companies know they can't charge more because people can't afford to buy them anyway.
Right. Yeah. Well, I wanted to bring up.
And what good would it do for those prices to rise so that Yellen gets her inflation target? So now people can never buy them. They can't buy them now. How are they going to buy them when they go up?
Right. Yeah. Well, you know how we talked about the earnings season is basically so over the next 2 or 3 weeks that all these companies are going to start reporting their quarterly earnings, right? Do you think that it's a coincidence, Louis, that some of the first earnings that we got were like Goldman Sachs and Bank of America? And one of the predominant things that most of their growth in the second quarter was investment banking. How
does that help the economy? How is that a sign of anything? Other than they rigged the casino and they're doing deals, M&A deals, because there's cheap speculative capital out there.
Well, and where?
And the other one is, their earnings are offset by their legal costs. Yeah, because they're out committing fraud. The cost of doing businesses, they have to up their legal expense exposure.
Yeah, but let's talk. But why wouldn't we want to talk about the more important things that would show, loan growth? Is there any loans taking place? No, they don't want to lend. They don't want to lend at these interest rates. So what do they do?
They're firing people in the mortgage industry.
Absolutely. And
Jamie Dimon was complaining the other day about the FHA. He wants nothing to do with mortgages.
No, they want capital. They want capital into their banks to reinvest back into the stock market and do what they want. And like I said, that's the only driver that we have of this economy. And
mergers don't produce. In fact, they're net job losers. They may produce some efficiency, but they're not a sign of increased sales. They're not a sign of increased activity. They're just a sign that it makes sense to do a deal, to put them together. And the economic value that's created in most mergers, a good portion of it goes to the investment bankers, the accountants, and lawyers who work on the deal, and the managers who get bonuses because they put a deal together. And if you know anything about mergers and acquisitions, there's been studies done, 70, 80, up to 90% of them never work out. So now whatever supposed efficiencies, synergies, all the buzzwords that they use for putting the two companies together don't come about. People lose their jobs. The new company isn't any better suited to compete or to make profits. And all the money that was done doing the deal goes to banks, lawyers, accountants, and executives.
And the primary basis for the merger was just to get rid of their competition, right? I mean, it wasn't to be
to compete better.
Right, to compete better, but it wasn't necessarily to be more productive because, as you just mentioned, that's not what happens.
No. Look at Time Warner as a classic example. Time Warner and Time Warner AOL. Those companies, their stock prices didn't increase for 10 years after the Time Warner merger, then the Time Warner AOL merger. That company didn't do any better. That's just one example. But a lot of people lost their jobs, and there was billions of dollars in fees, I'm sure, made by accountants, lawyers, and investment bankers.
Yeah, well, it's just like Facebook buys up every form of new technology that comes out, right? So anytime they see something that's getting hot, that's getting millions of users, that's all they care about.
Or users, like the what was that company? Oculus.
Oculus.
And users. just a piece of technology, and they took all the money they made in their IPO, not all the money, but, and they bought Oculus with it. Investment bankers got a percentage of that for arranging the deal. Some guy got money for inventing it. Good for him. But that doesn't drive the economy. Now that Facebook owns a piece of technology and they paid billions of dollars for it, so what?
Yeah,
no job was created.
Well, it looks like we're going to have to pay attention over the next weeks and months now that Yellen has said that looks like, junk bonds and the tech stocks are beginning to be stretched. I'd be curious to see how traders actually react. And you know how you mentioned that we could see that drop, and then everybody gets like this sense that, looks like it's time to buy back in type of deal, and then it drops again.
Mm-hmm.
Well, do you think, because everything is such it looks like a coordinated effort, right, by the Fed and all these big institutions, because most of the stock market and the buying is institutional buyers, right? So is this going to be something that's
institutional and sovereign, as you mentioned last week, 2 weeks ago?
Right. So do you think that it's going to be one of these timed efforts, like where basically all these institutional buyers they're going to get out all at the same time? Because at some point...
It's a stampede. It's a stampede for the one exit. That's what's going to happen.
And most of which would probably be these companies playing both sides of things, right? So shorting and making money despite whatever happens to the markets. And who, in the end of the day, who ends up getting crushed and hurt by all this, Lewis? It's the everyday average Joe that's got their money and 401ks and retirement.
It's going to be a massive, massive collapse. It's not going to be a one-day event. I think the stock market is not going to go down 15, 10%, healthy correction. It's going to go down, and it's going to keep going down.
So you're thinking like a 40% correction?
Absolutely, and it's not going to improve. And that's when they're going to start really clamping down and saying, here's what we have to do, emergency measures and so on, because you cannot regain confidence in these companies. You can't blow them back up.
Right.
If for example, if you look at the housing internet stocks, if there is no housing recovery and there are no homes being sold, and these companies have valuations in the billions of dollars based on the number of users, well, they're not going to get any more users. They already have tens of millions of users, and they don't make money on that. Why would you jump back into that? On what basis would you say, well, they're going to do this or they're going to do that? What are they going to do?
Right.
They're not going to make any money, so why would you pour your money back into it and say, well, you'd go after the blue chips? What blue chips? You're going to go into FedEx? If economic activity is going to slow down, you're going to bet on that there's going to be more packages shipped? It's not going to happen. I mean, you can't name me an industry that's going to do really well if the stock market collapses, other than short-selling hedge fund boutiques, a few mining stocks. But why would these companies become more attractive if their prices fall? If their prices fall, it'd be an indication confidence is lost, that there's nothing behind them. So they'll fall to where they should go, Ryan, which might be 30, 40, 50%. Then they'd be fairly valued.
Right.
And they'll stay there. And the thing is, then they'll start to drift lower, in my opinion, because that means they're fairly valued in today's economy where all that money is pumped in and they've managed to get some benefits from the QE and some benefits from the rising stock market. But you take a rising stock market out of the equation where some of that money was being pumped back in through buybacks and pumped back in because people had more money. If that's gone, then their outlook is even worse.
Right.
So you don't even just reduce yourself to where you should be today. You have to reduce yourself where you will be when you take away today's frothy environment. I just don't see how this lasts much longer. And I've been saying that for a while, but I thought that the entire thing went, but I'm thinking we saw the limit to the real estate market, and it's hit it. It's not going anywhere.
Right.
Once people realize the stock market's hit its limit, and all you have is downside, people are going to run out.
Yeah. Well, I've been thinking the same thing too, but on the flip side of the coin, I'm like just so convinced that it's not going to happen. It's not going to happen on Obama's dime, right? I'm sticking to that. They will find a way, come hell or high water, that it will not happen on his dime, and they will create a diversion of whether they have to we start bombing another country, we do something that won't allow for the stock market to crash, but so far, because, see, if the stock
how does bombing another country make the stock market go up? Like I said,
not make it go up, but take the limelight back off of our economy again, right? And then the flood of money goes back into bonds, and they can create,
Well, that's different though, Ryan. If money flows into bonds, though, that's like it for the stock market.
Well, no, but what they can do is they simultaneously start creating, employment reports that are stabilizing again, and then that.
Yeah, but you can't do that if the companies are, when these stocks get hit, Ryan. For example, some of the Silicon Valley social media stocks, they'll fire people. And there'll be lots of them just firing people. That'll have an impact on the job numbers. That'll have an impact on who can buy homes. Home prices in the San Francisco Bay Area, New York, Wall Street, and so on. But they don't realize that they've built the entire economy on the stock market. And that's right. They need to keep it up. You cannot keep putting on, when you're making a toothpick castle, at some point you can't put any more toothpicks on.
Right. Yeah, well, and you mentioned, in the language that Yellen just used at her last testimony, pointing out specific sectors, right?
They want to slow it down. That's what they want to do because they know if they don't, it's going to collapse in a dramatic fashion. Yeah, and they want a controlled collapse. They don't want the whole thing. People to wake up and say, "My God, what have I done? Why do I have these stocks?"
Right. Well, and that's why most of what you're saying, of the fundamentals behind what should take place. There's fundamentals for all this stuff, but the fundamentals haven't mattered. They matter, but they haven't mattered.
At some point, they're going to, Ryan. Otherwise, you just have a total government take over the stock market, and they just tell you they go up this week.
Well, I wouldn't be surprised if that did happen. You know what I mean? At this point, nothing would surprise me because why wouldn't the government just control every single thing?
That's what they want to do. That's the nature of central planning. That's what they want.
That's more of my point.
They want a result, and the result is they want people to have jobs, and they want the stock market to go up.
So what better way to masterfully pull this off than to be in control of everything? And honestly, I don't really see any other alternative at this point because it's so far gone.
Ridiculous.
Okay, so you let the world just collapse. Our country would essentially just collapse. So if they take it over, well, we can control how slow it collapses. You know what I mean?
Yeah.
Unfortunately, I wish that I didn't have to think that way, but all the rhetoric and the language and the media and the president and Congress, it's really gotten to be absurd where we're at. It's just nice to be somebody that's sitting on Wall Street or the owners of one of these companies that just can just have the money pouring in and they're really not having to do anything but play golf.
And occasionally every quarter deciding how many shares of their company they need to buy back.
Right. Yep. Well, we're coming up on the end of the show, Louis. It was obviously interesting as always. We'll have to keep our basically our eyes and ears open for what takes place, and really watch the stock market over the next couple of weeks and see what happens. See if something does change significantly. But people, if they want to follow your weekly blog, you normally have a couple blog posts up a week. Would you give them that your website that they can check out and follow you?
Sure, thanks. It's Smallgold, SMAULGLD, smallgold.com. That's the website. You can also follow me on Twitter at Smallgold, SMAULGLD. Thanks, everyone, and thanks, Ryan.
Thanks, Louis. Appreciate it. Thank you guys for tuning in. Remember, subscribe, download on iTunes, search Real Estate 360. You can also ask any questions you have or stream the show on the website. We have all the past episodes on there at realestate360live.com. Until next time, guys, take care.